Hi everyone, this is a summary video on hedging strategy. I've already covered it in my previous videos in more details, I mean every topic of it. Here I'm trying to summarize again more for myself, but also for the benefit of audience. What we are talking about here, we are talking about foreign currency hedging. So it's not something else, it's foreign currency cash flow hedging. Let me put it on the paper, on the board. In our case, it's foreign currency cash flow hedge. Okay, I will briefly elaborate on what, how, and when framework. For what? You're starting with your currency mix. That's very important thing. So you're starting to understand what is your exposure, what you are afraid of, what you're trying to protect your company against. Try to make it as simple as possible, but review multiple times your outputs and your inputs to be 100% sure that you're having the right numbers in place and you have the right forecasts in place. I don't remember who it was, but there is a saying that it's better to be approximately right than completely wrong or wrong in details. Anyways, try to make it high level. Your currency mix for what to hedge. You have your currencies, and you're forecasting the cash flows in these currencies if these are not your functional currency. So your goal here, if you're speaking about cash flow hedge, is to protect your cash flows, inflows or outflows. And by protection, I mean to know the exact trade that's gonna be applicable for your business in future. So you're basically buying predictability, paying some sort of premium. If you're using forward contracts, you're paying forward points. If options, you're paying your premium upfront. Okay, you know what to hedge. You've done your exercise with forecasting. You've reviewed all of your forecasts as many times as you feel appropriate. And by that I mean like at least 3 times from the beginning to the end, not during the single day, during several sessions. Better to do it 10 times or 20 times, because in that case you will understand better what's going on in business, especially if you're not selling the product you naturally don't know, you don't feel it. When you do it multiple times, you will have better understanding of what's going on and what the actual risk is. Communicate with people, communicate with other departments to understand better what are the problems, what are the risks, what exactly the risk. Sometimes at the surface it feels like you have to hedge because you have that currency mix that is not your functional currency, but in reality it might not be a problem and it might be solved differently. Don't use derivative instruments as a first stage protection. Try to solve it naturally. So try to negotiate with the vendor if it's vendor. Try to sell in foreign currency if you have OPEX in foreign currency, if it's possible. So consider all these options before jumping into the hedging exercise. Okay, you are comfortable with this one, you know what to hedge. The next one is how to hedge. How to hedge. If we speak about foreign exchange cash flow hedging, there are several instruments that are commonly used. These are forward contracts, options, colors, and also traded at the market forward futures. Okay, I will not stop on plus and minuses futures versus forwards. I will just elaborate on my preference. My preference is forward contract, especially if you are not trading on a daily basis, for several reasons. With the forward contracts, it's easier to compare. It's easier to get comparable prices from several brokers and identify which one is better, which one is more competitive. And for colors, for example, as a combination of two options, one that you're buying and one that you're selling, it's easier for broker to put some hidden commission inside, and it's harder for you to compare among the brokers because it's over the counter. It depends on supply and demand for particular broker, and obviously it depends on price and strategy of that particular broker. For options, it's great instrument, it's comparable, but here you have to pay your premium upfront. That's a problem for cash flows, and that's what many companies try to avoid. So that's why my preference is forward contract. But consider your risk appetite and decide for yourself. Don't listen to anyone, myself inclusive. It depends heavily on your particular situation. Once you do what to hedge multiple times, I will emphasize it here like 10, 20 times for this exercise, you will have better sense what is the best option for you. Also, do your homework here as well. Select from 3 to 5 brokers. Check the prices in advance, way before you decide to trade, just to understand how do they price, how quickly do they react to your message, what's the process inside the broker, do they need to money to be transferred to them, and what are the margin requirements, if anything. So do homework. Again, this is to this statement, 220 times. Do this a couple of times. Compare broker. Be prepared. You should know what brokers are the best at particular moment of time, and if they change over the time. So do a couple of checks before you actually go into trading mood. And the last one, but not the least, what, how, and when. For them, it's no one knows, like literally. I had several conversations with analytics from the big institutions, big banks, big brokers, and all of them delivering the same message. If they would know, they would never sit and speak with me, because they would rather outplay the market. And for the FX, fluctuations is different from the share price, because for the share price, company might rocket to science or might go bankrupt. It's really unlikely, at least in medium term, that Euro Union or United States will go under. So it's unlikely that one currency will significantly, and by significantly I mean 30, 40, 50% depreciate against another currency. When I'm proposing, not to everyone, that's what I'm doing in my practice. We have market indicators if we are at the normal market. If the market is about the same level, moving up a bit, moving down a bit, or up, we have indicators inclusive moving averages. When the faster moving average crosses a slower moving average on its way upwards, we see it as an indicator to look closer at the market. Then obviously we follow strictly interest rates parity model just to understand the trend. So we are not forecasting the rate itself, we are forecasting the actions of the central banks between these two countries to understand where the rate most likely go in the future. Again, disclaimer, most likely, no one knows. There are certain geopolitical shifts that might affect the rate heavily, as we see currently at the market. And in the situation like this, it's April 2026, no one knows where the rate will go. We are just considering our budgeted rate. That's also a very important hint, budget. If you already have something written in the budget, and if that rate already approved by the board of directors, I mean, even not explicitly, but implicitly, they approving the rate by approving the profit and loss and cash flow forecast. If it's approved and you see the market doesn't behave well, it goes up and down at wide fluctuations, at wide percentage, why don't, just ask yourself, why don't you just buy at the rate that is more preferable than the budget rate? You already have it approved. And if it's currently better, just buy and have your rate locked at the level that is more favorable than your budget rate. This is just thinking, this is not the particular call of action, it's just my thoughts, but I think it's worth to consider. For the normal situation, you should have built-in process how to decide when to hedge, and it probably will be based on some technical indicator as moving averages, on some consensus forecast, on interest rate differential, on your budget rate. But it's all related. I mean, your budget rate also goes from your forecast on interest rates and consensus from the brokers with whom you are having a business. Okay, I hope that was useful, at least a couple of thoughts that might be worth to think about. Main message here, overall, be prepared, do your homework, and you will avoid a lot of pain and a lot of losses in the future. Decide what to hedge, decide how to hedge well in advance, and decide on the process when to hedge. Look at the budget. If the rate goes more beneficial, maybe it's a good time to lock in having the current market conditions. Okay, see you soon. Thank you.